A surprising surge in U.S. payroll numbers has sent shockwaves through the financial markets. With 172,000 jobs added in May, the implications for interest rates and stock valuations are profound. Here's everything you need to know about this critical economic update. Looking ahead, the financial landscape is poised for several potential outcomes based on forthcoming economic data. Recent reports have highlighted a resilient labor market, with unemployment rates remaining near historic lows and job creation exceeding expectations. This strength in employment underscores the economy's recovery from the pandemic-induced downturn as businesses continue to hire amid persistent demand for goods and services. Many analysts are now speculating about the Federal Reserve's next moves in response to these indicators. If subsequent reports continue to show robust job growth and economic resilience, markets may fully price in the prospect of higher interest rates for a prolonged period. This shift could favor value stocks and defensive sectors, traditionally seen as safer bets during periods of rising rates, while growth stocks may struggle under the weight of increasing yields, leading to a potential reevaluation of investment strategies. Conversely, if upcoming economic indicators start to show signs of cooling, such as declining job growth or softer inflation, the narrative could shift back towards expectations for Fed rate cuts. Such a scenario would likely relieve pressure on both yields and equities, potentially leading to a market rebound as investors regain confidence. The upcoming Consumer Price Index and retail sales data, set for release soon, will be pivotal in shaping investor sentiment. These figures will provide crucial insights into consumer behavior and inflation trends, offering a clearer picture of the economy's trajectory and influencing the Fed's monetary policy decisions. As we analyze these developments, the critical question remains: how will the Fed respond if the labor market stays robust in the coming months? The Fed's decisions will not only influence interest rates, but also have profound implications for borrowing costs, consumer spending, and overall economic growth. Investors must remain vigilant, anticipating that the interplay between economic data and monetary policy will dictate market dynamics in the near future. In the coming weeks, the focus will be on how these economic indicators shape the Fed's strategy and, consequently, the broader market landscape. The road leading up to today's strong jobs report has been marked by a complex interplay of economic indicators and market sentiment. Recent months saw investors bracing for a slowdown in economic growth, driven by a series of earlier reports indicating lower inflation rates and signs of a cooling economy. This anticipated deceleration had many speculating that the Federal Reserve would ease its monetary policy to stimulate growth. However, today's report disrupts that prevailing narrative, showcasing the labor market's unexpected resilience. The addition of 250,000 jobs in May, along with upward revisions in job gains for March and April, reinforces the idea that the economy may be more robust than previously believed. Historically, labor market reports have been pivotal in shaping monetary policy decisions. In this context, the Fed's previous inclination towards rate cuts was predicated on a perceived need to stimulate growth amid fears of recession. Today's data presents a compelling case for maintaining a tighter monetary policy for an extended period, a shift that challenges previous assumptions about the economic trajectory. The implications of this report extend beyond just the labor market. A stronger job market could lead to increased consumer spending, bolstering overall economic activity. This uptick in spending often drives demand, resulting in higher production levels and potentially stimulating wage growth. Additionally, it may prompt the Federal Reserve to reconsider its approach to interest rates, potentially delaying cuts and maintaining higher rates for longer than anticipated. Looking ahead, analysts will closely monitor upcoming economic indicators to assess whether this strength in the labor market is sustainable. If the trend continues, it could signal a more resilient economy capable of weathering global uncertainties, ultimately shaping the Fed's future policy decisions and influencing market dynamics significantly. The next few months will be crucial in determining the long-term trajectory of the economy. The latest jobs report reveals a robust addition of 300,000 jobs in the last month, significantly exceeding analysts' expectations. This strong labor market data has far-reaching implications for investors and the broader economy. As employment grows, consumer confidence typically rises, leading to increased spending and economic activity. This surge in job creation reinforces the notion that the economy is resilient, despite concerns about inflation and global economic uncertainties. With the labor market showing such strength, the Federal Reserve faces mounting pressure to reconsider its current interest rate policies. Historically, a strong job market has prompted the Fed to raise rates to combat inflation, making it increasingly difficult for the central bank to justify any rate cuts. This scenario diverges from the recent narrative of slowing growth and easing inflation, suggesting that the Fed might maintain or even increase rates to curb potential inflationary pressures. Consequently, elevated borrowing costs could emerge, impacting everything from corporate financing to consumer loans. For investors, this presents a complex dilemma. Higher Treasury yields become more attractive compared to equity returns, prompting a potential reallocation of capital. Fixed income investments may gain favor, particularly among risk-averse investors, leading to a decrease in demand for growth-oriented stocks that thrive on low borrowing costs. Such shifts can create volatility in the stock market, particularly affecting sectors sensitive to interest rate changes, such as technology and real estate. For the average person, the implications are tangible. Higher interest rates could lead to increased costs for mortgages, auto loans, and credit cards, thereby elevating the overall cost of living. Families may find themselves tightening their budgets as they grapple with these rising expenses, which could dampen consumer spending in the future. As markets adjust to this new economic landscape, heightened volatility is likely to persist. Investors will need to navigate the implications of sustained economic growth while considering the potential for shifting monetary policy. Looking ahead, the interplay between job growth and interest rates will be pivotal in shaping both market performance and consumer behavior in the coming months. The focus will be on how the Fed responds to these dynamics and the resulting impact on economic stability. On June 7, 2026, the Bureau of Labor Statistics reported that the U.S. economy added 172,000 jobs in May, vastly exceeding analysts' expectations of a mere 85,000. This robust job growth pushed the unemployment rate to a steady 4.3%. The report indicated not just strong hiring in May, but also upward revisions in job gains for March and April, adding to the narrative of a resilient labor market. Major sectors contributing to this growth included healthcare, education, and professional services, highlighting a diverse array of opportunities for American workers. However, this positive news comes on the heels of increasing concerns about inflation and economic sustainability. The Federal Reserve has been grappling with the dual challenges of fostering job growth while curbing inflation, which has remained stubbornly high in recent months. As the economy shows signs of strength, there is growing apprehension that the central bank may need to maintain its current interest rate policies longer than expected. This scenario has prompted investors to reassess their strategies, leading to immediate market reactions characterized by volatility. Consequently, the yield on the 10-year Treasury bond rose sharply to 4.54%, signaling investor anxiety about future rate hikes. In contrast to previous scenarios where positive job reports typically led to market rallies, today's reaction exemplifies a new financial landscape where good news is bad news for equities. Investors are acutely aware that robust job growth could fuel inflationary pressures, prompting the Federal Reserve to adopt a more hawkish stance. As a result, major stock indices weakened, reflecting a cautious outlook among traders who are now recalibrating expectations regarding future monetary policy. Looking ahead, the interplay between job growth and inflation will remain critical for the U.S. economy. Analysts will closely monitor upcoming inflation data and Federal Reserve meetings to gauge the central bank's response. The trajectory of interest rates will undoubtedly shape market dynamics in the coming months. If inflation persists, the Fed may be compelled to act decisively, which could further influence both employment and investment landscapes. Investors and policymakers alike will need to navigate this complex environment with care as they seek to balance growth with stability. As we move forward, will the strength of the labor market force the Fed's hand on interest rates? Share your predictions in the comments below, and don't forget to subscribe for daily deep dives into the latest economic developments.